Did something happen last Saturday that the financial media is completely refusing to discuss? While you were asleep, while the markets were closed, institutional traders executed a massive $2.1 billion silver position dump through offshore trading desks. This was not just random profit-taking. This was coordinated. It was deliberate. And the timing reveals something that should genuinely concern every single silver investor watching this right now. I've spent the last 72 hours tracing the money flow, analyzing the COMEX data. And what I discovered points to a pattern we haven't seen since the 2011 silver crash. The question isn't whether this affects your portfolio. The question is whether you understand what's actually happening before Monday's opening bell. Now, here's what makes this situation so different from normal market volatility. When institutional money moves on a Saturday through Hong Kong and London trading desks, they're not reacting to news. They're positioning themselves ahead of news. They know something. And based on the sectors they're moving into, that something involves a major shift in the silver supply narrative. Most retail silver investors are going to wake up Monday morning, see the price movement, and panic. They'll make emotional decisions based on the surface-level story. But the traders who understand what Saturday's dump actually signals are preparing to do the exact opposite. That $2.1 billion wasn't an exit. It was a repositioning. And the difference between those two interpretations could mean everything for your holdings over the next 90 days. Before I break down exactly what this Saturday leak reveals, I need to ask something from you. If you're serious about understanding precious metals, if you're tired of surface-level analysis that misses the real story, then this channel was created specifically for you. Take just 2 seconds right now and hit that subscribe button, because the institutional moves happening behind the scenes aren't going to wait for anyone to catch up. Also, drop a comment below and tell me where you're watching from. Are you in the United States, Canada, Australia, or somewhere else around the world? I read every single comment personally, and I want to know who's paying attention to what's actually happening in these markets. Now, let us decode what this $2.1 billion Saturday dump truly reveals about the silver market. As next major move. Saturday, trading in precious metals operates through a shadow network that most retail investors don't even know exists. While the COMEX is closed, silver trades continuously through Hong Kong's offshore desks, London's over-the-counter markets, and various Asian exchanges. The volume is typically thin. Price movements are usually minimal. It's essentially maintenance mode for the global silver market. But last Saturday broke every single pattern we track. Between 2 a.m. and 6 a.m. Eastern Time, approximately $2.1 billion in silver futures contracts changed hands. The selling pressure was concentrated, methodical, and clearly coordinated across multiple trading desks. This wasn't scattered retail selling. The lot sizes, the timing intervals, the specific price levels where orders were placed, all of it points to institutional execution. Let that sink in for a moment. Someone, or more likely a group of connected institutional players, decided that Saturday morning, when liquidity is at its lowest and retail investors are completely absent, was the perfect time to move $2.1 billion. So why would they do that? There are really only two logical explanations. The first possibility is that they're repositioning ahead of negative news they expect to hit Monday or Tuesday. Perhaps a major economic announcement, a policy shift, or supply data that hasn't been publicly released yet. The second possibility is that they are deliberately pushing the price lower to accumulate physical metal at cheaper levels before a supply squeeze they see coming. The data points overwhelmingly toward the second explanation, and here's why. When I traced the flow of that $2.1 billion, something unusual emerged. The selling occurred in paper futures markets, but simultaneously, physical silver purchases through Shanghai and Singapore spiked dramatically. We are talking about a divergence between paper selling and physical buying that we have unwitnessed at this scale in over a decade. Someone is selling paper silver aggressively, while at the same time accumulating physical metal. That's not panic. That is pure strategy. Now, identifying exactly who executed these trades is difficult by design. The offshore trading network exists specifically to provide institutional anonymity, but we can analyze the fingerprints they left behind. The trading pattern matches what analysts call controlled distribution. This is a technique where large positions are unwound gradually, at specific price intervals, to minimize market impact while achieving a target average exit price. It requires sophisticated execution algorithms and access to multiple trading venues simultaneously. Retail traders don't have this capability. Small hedge funds don't have this capability. This is the signature of major institutional players. We're talking bullion banks, sovereign wealth funds, or large commodity trading houses. And here is where it gets really interesting. 3 of the largest bullion banks have been steadily reducing their registered COMEX silver inventory for the past 6 months. Their vault holdings are approaching multi-year lows. Now, if you're reducing your physical inventory while simultaneously selling paper contracts, you're creating a very specific setup. You are manufacturing lower prices in the paper market while you know physical supply is tightening behind the scenes. When the paper market eventually has to reconcile with physical reality, the snapback becomes explosive. This is the exact pattern that preceded the 2020 silver squeeze. This is the pattern that preceded multiple historical silver rallies. Institutional players suppress prices through paper selling, accumulate physical metal at the artificially lowered prices, and then they simply step aside when supply reality forces prices higher. The $2.1 billion Saturday dump fits this pattern perfectly. It's too perfect to ignore. But there's another dimension to this story that most analysts are completely missing. And it has to do with something that happened at the very same time on the other side of the world. Ever noticed how silver prices sometimes just fall off a cliff for no apparent reason? Well, a recent Saturday dump in the silver market might seem like bad news, but it's actually pulling back the curtain on something huge happening behind the scenes. And if you're a silver investor or thinking about becoming one, you need to understand what's really going on. This strange price drop isn't random. It's happening right as industrial silver demand is exploding into what experts call a couple call structural deficit phase. Think about it. Solar panel manufacturing chewed up over 140 million ounces of silver just last year. Every electric vehicle needs about half an ounce of silver for its electrical contacts and battery connections. And the global 5G rollout. Silver is in practically every single base station and connected device. These aren't some far-off predictions. This is happening right now, and the demand is growing month after month. But here's the kicker. While demand is skyrocketing, silver mine production has been completely flat. The world's biggest silver-producing countries, Peru, China, are all facing the same problems: lower quality and higher costs to get it out of the ground. Primary silver mines are barely keeping up, let alone increasing their output to meet this new demand. And this leads us to the most critical detail that most investors miss. Around 70% of all silver isn't mined from dedicated silver mines. It's actually a byproduct of mining for other metals like copper, zinc, lead, and gold. This creates a really weird situation. It means silver supply is what we call inelastic. It doesn't respond normally to price changes. Let's say you own a copper mine. If the price of silver doubles overnight, you don't just magically start producing more silver. Your main business is copper. You're going to mine based on copper prices, not silver prices. This simple fact means that no matter how high the price of silver goes, we can't just flip a switch and produce more of it. The supply is handcuffed to the economics of completely different metals. Now, the big financial institutions, the ones making those strange trades on a quiet Saturday, they know this inside and out. They're not confused about silver's supply problems. In fact, they're using them to their advantage. By orchestrating a price dump when trading is thin, they achieve two goals at once. First, they spook retail investors, people like you and mine, to panic selling. They create fear, and when people sell out of fear, they sell cheap. Second, this allows them to swoop in and buy up physical silver at artificially low prices, prices that have no connection to the real-world supply and demand situation. They're essentially creating a sale for themselves. This is the real secret that Saturday's price dump reveals. It's not a sign that silver is weak. It's a sign that the big players are getting into position aggressively because they see a massive supply-driven price shock on the horizon. They see a future where industrial users are scrambling for physical silver that just isn't there at today's prices. And when that happens, the price has to readjust, and it will happen fast. So, what should you, the individual investor, do with this information? The absolute worst thing you can do is react emotionally. If you see the market open lower on Monday because of this manufactured pressure and you hit the sell button, you're playing right into their hands. You're handing them your silver at a discount and taking a loss. The smart move is to see this for what it is: a manufactured buying opportunity within a much larger, long-term bullish trend for silver. Professional traders have a playbook for situations just like this. First, they ask themselves if the fundamental story has changed. Has industrial demand for silver suddenly stopped? Has someone discovered a mountain of new, easy-to-mine silver? The answer to both is a clear no. The fundamentals are stronger than ever. The aggressive moves by institutions actually confirm that they believe in silver's future. Second, they identify their accumulation zones. When paper prices are pushed down like this, it creates a chance to buy at levels that shouldn't exist. The key is to have a plan. Decide beforehand what prices you're willing to buy at and add to your position strategically, instead of making panicked moves based on daily noise. Third, they practice disciplined position sizing. This situation is a perfect reminder that big institutions can and will move markets in ways that are totally unpredictable. Your investment size should always be managed in a way that allows you to ride out this kind of volatility without losing sleep. Never go ELD on a single trade. The investors who will come out on top are the ones who understand this growing split between the paper market, with all its games and volatility, and the physical market, with its undeniable realities. Right now, those two worlds are drifting further and further apart. But eventually, that gap has to close. And when it does, it's not going to be a gentle correction. It's going to be a violent snapback. History shows that when this happens, it's the holders of the physical asset, not the paper traders, who reap the rewards. Thanks for watching. If you found this breakdown helpful, make sure to like and subscribe for more insights into the markets. See you next time. All right, silver investors, let's cut right to the chase. There's a hard truth that many in our community just don't want to face. The game, as it's currently played, is rigged. It's not a level playing field. Big institutional players, the banks, the hedge funds, they have advantages we can only dream of. They have instantaneous access to information we get days later. Their execution capabilities are light years ahead of what we can do from our home computers, and their market timing. It's surgically precise. They are, for all intents and purposes, playing with a marked deck. But here's the crucial part, the part they don't want you to realize. They have a massive, glaring weakness, an Achilles heel, and that weakness is time. They don't have patience. They can't afford it. These giants operate on strict quarterly performance cycles. Their entire world revolves around showing profits every 90 days. They face immense pressure from their clients, who can demand their money back at any moment, what's known as redemption pressure. This forces them to chase short-term gains, often at the expense of long-term strategy. They absolutely must deliver returns within these narrow, unforgiving timeframes. If they don't, heads roll and funds get pulled. This is where you, the individual investor, gain an extraordinary edge. an advantage that these billion-dollar institutions simply cannot replicate. If you understand the real-world physical supply and demand for silver, the stuff you can actually hold in your hand, you're already ahead. When you recognize that the manipulation in the paper markets, the futures contracts, isn't just a threat, but a massive opportunity, your perspective shifts. And most importantly, if you possess the psychological fortitude, the sheer mental strength to hold your ground through the inevitable price swings and volatility, you become their worst nightmare. You have the one thing they lack: the luxury of patience. Let's talk about what happened last Saturday. A staggering $2.1 billion dump in the silver market. For many, this looked like a catastrophe, a reason to panic. But if you know how to read the signs, it was anything but. This wasn't a threat, it was a signal. It was a flare in the night sky. This is the institutional playbook laid bare. They are revealing, through their actions, exactly what they anticipate is coming next. Think about it. When the big money makes a move of this magnitude on a Saturday morning of all times, routed through offshore trading desks to minimize immediate detection, they are not just guessing. They are not gambling. They are strategically, deliberately, preparing for a major market shift. This kind of coordinated action is designed for one purpose: to shake out the weak hands. They want to trigger stop losses, to ignite a cascade of panic selling from retail investors. Why? So they can scoop up positions at artificially suppressed prices before the real move happens. They are manufacturing a fire sale so they can be the primary buyers. They need your physical silver, or at least your paper claims to it, and they will create whatever market chaos is necessary to get it from you cheaply. So, this brings us to the most important question you need to ask yourself right now. When the dust settles, where will you be positioned? Will you be standing alongside them, having used this manufactured dip to strengthen your own position? Or will you be one of the casualties, one of those who sold at the very bottom, only to watch the inevitable rally from the sidelines, filled with regret? The choice is yours, but it's a choice you have to make with conviction, based on understanding the true dynamics at play, not the manufactured headlines. This is the deeper story behind Saturday's dramatic silver dump. It's not about a sudden loss of faith in silver. It's about a calculated repositioning by the most powerful players in the market. They are getting ready. The only question is, are you? Now, I really want to hear from you. This is a community, and our collective intelligence is our greatest asset. Drop a comment below and tell me your take on this. What's your interpretation of the Saturday event? Are you using these manipulated lows as a buying opportunity to add to your stack? Are you holding steady, trusting your long-term thesis and weathering the storm? Or are you genuinely concerned about what these institutional moves might signal for the short term? Or are you genuinely concerned about what these institutional moves might signal for the short term? I read every single comment, and believe me, these discussions are invaluable. They help shape the analysis for future videos and help us all get a clearer picture. If this breakdown helped you see beyond the surface, beyond the scary headlines, and understand what's really happening in the silver market, do me a favor and hit that like button. It's a simple click for you, but it massively helps the YouTube algorithm show this video to more silver investors who need to see it. We need to get this information out there so more people can understand the real forces moving these markets. And if you haven't already, subscribe to the channel and make sure you click that notification bell. The institutional moves are accelerating. The signals are getting clearer. And you can bet I'll be right here to decode every significant development as it unfolds, if you don't want to miss the next update. This is Silver Cipher. My goal is to help you stay informed and stay strategic. Never, ever let the games they play in the paper markets shake you out of your position in physical reality. Thank you for watching. I'll see you in the next one.